Hello, welcome to this week's Economy with Dr. Vance Ginn. I'm your host, Dr. Vance Ginn. This is another week with a lot of information going on in the economy that I really want to get right into, but thank you for joining me. Today, I'm recording this on April 13, 2023. So usually I record it the day before it goes out the next morning. That really provides an overview about what's happening in the economy, the news that you need to know about what's happening, not only at the national level, but also at the state level, to where I'm trying to provide a niche, something that other people aren't covering as much. So I hope you're enjoying these episodes that come out weekly. They're short, 10 to 15 minutes that you'll share with others. And please leave us a 5-star rating and subscribe to wherever you can. You can also find the show notes at vanceginn.com and my Substack, vanceginn.substack.com, where you can subscribe and get these in your inbox every day. So please consider doing that. First thing I wanted to mention is that on the Let People Prosper show that came out on Tuesday, which is my podcast that I interview a lot of people on key important issues that are going on, I was glad to have my colleague and friend and Daniel Esparma he's a CEO of the Pelican Institute in Louisiana. We talked about a lot of things, including fiscal reforms, the things that Louisiana is not getting right that they need to improve on because they have net out migration. So how do we get people to stay in Louisiana and really flourish? We talked a lot about that, really a flat tax, eliminating the income tax over time, and responsible budgeting are going to be key there. School choice, the importance of that, not only in Louisiana, but across the country. Tech freedom to make sure that we are empowering parents and not bureaucrats through policy. I think there's a big push to have a lot of government influence within the tech space, social media, and everything else. We need to be very cautious of that. That has not worked out very well in any other area. Why would we want to do that in something so important as technology? At the same time, I think that parents should be more cognizant of some of the risks that are going on there. And so I hope that you'll check out that episode. I'll have more on tech stuff here soon with another guest, Max Golker, which will be coming out soon. So check out some of those things as well. So without further ado, let's get right into the big three things today. The big three things today are going to be about inflation, right? With CPI inflation, the Consumer Price Index, that report was out this week by the Bureau of Labor Statistics. So I want to go over some of those key things. And that's also going to include some of the housing market as well. Number two, what's happening in some of the states when you think about budgeting in particular, and I'm going to talk about Texas because that's really going on and heating up right now about tax reform and budgeting and things of that nature, but also school choice. I want to mention a little bit about that. And number three, let's talk about the central bank digital currency, what that means for the United States, whether it's a good idea, and so forth. So let's get right into it. The Consumer Price Index, which is a basket of goods and services that an average typical urban household would buy. And so what they do is they do some surveys of a number of products, and they compare these to where the base years were 1982 to 84. And they say, okay, what has the prices done over time? There are biases. There's a substitution bias, like you choose different goods depending on the price. There's also a quality goods bias. So the quality of a lot of goods change over time. There's a new goods bias. So there's new things that come into that basket that aren't accounted for in CPI, but it provides at least some measure of what inflation, what prices are doing over time. I mean, my real take is inflation really deals with the Federal Reserve's balance sheet, okay, which is they've been manipulating the economy, putting a lot of money in the economy, buying a lot of government debt that's been issued over the last just couple of years, $7 trillion since 2020. So the Fed's balance sheet going from $4 trillion to $9 trillion and bouncing back and forth, and they're only down, a couple $100 billion now from where they were at their peak at $9 trillion. There's still a lot of liquidity in the marketplace. And so what are we going to see? We're going to see inflation. Now, inflation, if you look at the headline number that includes all the prices that are in the basket, was up 5% year over year. So it's still going up, right? 5% is down from the high of 9%. That was the peak of last year. What was that? That was, got it right here, May. Yeah. So, around March and April, May. Last year, it was right around 9% of 2022. So 8.5% in May of 2022. So it is down from that peak. Now it's at 5% in March of 2023. So that's good news. That's disinflation. There's not deflation, which when prices go down, but disinflation. So that's pretty good news. The problem is that wages are not going up that fast. Average weekly earnings are going up, let's say, right below 4%. And so inflation growing at 5% means that delta, that difference, means that in real average weekly earnings are still going down year over year for now 24 straight months, 2 years. It's crazy. And so that will probably mean 25 months coming up soon. So this is not a good thing there. If you exclude food and energy, which are volatile, the Federal Reserve likes to look at what's called the core inflation rate of excluding food and energy because they are volatile, although they're essential, right? So we're all buying them all the time. That rate was at 5.6%, 5.6%. It actually ticked up a little bit. And so, look, I think that there's still a lot of underlying inflationary pressures that are out there, especially with the Federal Reserve's balance sheet the way that it is and manipulating a lot of markets and putting all that liquidity out there, given what that, Congress has been spending too much and crowding out the productive private sector, raising taxes on businesses, and the regulatory climate that's just been terrible by the Biden administration. All those things are restraining supply. So more demand from that money, increasing or decreasing supply, or at least restraining it, you're going to get higher inflation. And so I think it's a good that in the sense of we have some disinflation that's happening out there, but there's more to go. I mean, this is still the highest inflation rates in 32 years since early 1991, which is 32 years ago. I was scratching my head earlier thinking that 1992 was or 1991 was already 32 years ago. Goodness. But when you look at some of the other inflationary pressures, when you break this down, I'll have this all on the show notes page. Food is up 8.5%. Food at home, 8.4%. Energy is down some, down 6.4% year over year, as we had a lot of those peaks in inflation of energy prices last year with the Ukraine war. The Russia invaded Ukraine and that sort of thing influenced that. And some of the other policies by the Biden administration have restrained oil and gas supply as well. Gasoline prices down 17%. So this is through March of 2023. Just to give you an idea of where this is at. But then if you look at new vehicles, they're up 6.1%, although used vehicles are down 11.2%. The services less energy is up 7.1%. So what we've seen is that there's still a lot of inflation within food. Food prices keep going up. Services sector keep going up. And so I think that is going to contribute to higher inflation, at least elevated inflation for a longer period of time, to where I think that the Federal Reserve must continue to raise their target federal funds rate, which was a 0% last year, and now it's 5%. So they've increased it quite a bit. But if you look at something like the Taylor rule, which accounts for GDP growth and inflation, it shows that it should be at least 6% right now. That's what the target federal funds rate should be, according to that Taylor rule, which I'm a big fan of, actually. I think the Fed should be controlled by a rule until we can end the Fed entirely. That's really where we need to be. But those are some key things, think about. I think ultimately the Fed also needs to be more aggressive in cutting its balance sheet. That's really where you get the manipulation of the economy. Another thing that I wanted to look at is, so shelter and the CPI is up 8.2%. So what does that mean for housing prices? So you look at something like the Case-Shiller National Home Price Index, and it's the base year is in 2000. It was at 100. Well, now that index is at 292.7 in January of 2023, the latest number. So that means it's up 193% in just a little over 20 years. Now, the peak of this was at 301. So home prices are down a little bit from their peak. And that peak was back in let's see, that was in June. 308 actually was the highest it was. And so that's in June of 2022. So home prices have come down some since then. And so that's going to be reflected in a lot of values across the country. Now, that's not picked up within the shelter price index because there's kind of a lag going on there. So that could help with some of the higher inflationary pressure across the economy, but something to watch. But in Texas, where I live, home prices are down some as they peaked about 300,000. If you look at Zillow's numbers, and now they're at 294,000. So if I looked at that and said, all right, 294 divided by 300 minus 1, home prices across Texas are, and this is as of March 2023, are down about 2%. And that's reflected even in the appraisal that I recently received from our Williamson County property district. And this is something that's going to influence a lot of Texans because, and this gets into our state report, right? What's happening in the states is that Texas is really looking at some pretty massive property tax relief. That's the number one burdensome type of property tax in Texas, sixth most burdensome in the nation for homeowners. And so there are different proposals that are out there by the House where they're looking at compression, meaning reducing school district M&O property taxes by about $12 billion. They're also looking at appraisal caps of lowering the appraisal cap from 10% on homesteaders to 5% for all real property. I'm more focused on that compression part. The appraisal part really just shifts the burden around. And you're still going to have increasing over time where we really need our lower property tax bills, not just slowing the growth. And so I think that we really need to look at more of the compression and have even more dollars going to compression, because the largest amount so far was $14.2 billion that put towards property tax relief in 2008-09. And if you adjust that for inflation, it's now $20 billion. So $12 billion of new property tax relief isn't going to cut it for the House, right? And so there needs to be more relief there. And the Senate's latest numbers from their budget that they just released, and it's going to be out there here soon, they only have $15.1 billion in total, but $5.3 billion of that goes to maintain current property tax relief, the same thing the House has. So the House's total number is $17 billion, but only $17.3 billion, but only $12 billion is actual new property tax relief. That's the number you want to look at. In the Senate, though, that $15.1 billion minus 5.3 is only $9.8 billion of new property tax relief, which is a mixture of raising the homestead exemption, which again just shifts the burden around, doesn't reduce property taxes, and it goes away quickly because home values continue to go up, even especially the appraisals, even though they've went down a little bit right now. Your appraisal went up a lot more. Over time, we've seen a huge increase just since 2020, of July of 2020. We've seen a 41% increase in home prices on average in Texas, 41%. So you've got a lot of growth that's going to happen there over time in the prices. So the appraisal caps don't really do much. The homestead exemption is not really going to do much, especially when you think about lowering property taxes. There's some personal property tax relief in the Senate's package that I think could be helpful. But ultimately, you want as much money towards compression, meaning returning taxpayer money to them through compression. We've got $32.7 billion in surplus in Texas. That money should go back to the taxpayers as much as possible. There's a lot of good bills that are out there to do that. I hope they can put more of that in there. And when you look at the Senate's new budget, we talked about the House budget last week. The Senate's budget, if you look at the total all funds budget from appropriations of 22-23, so biennium, to 24-25 biennium, it's up 16.3%, just a massive increase. This is more than the increase in the House, about 14.3%. And just state funds alone is up 25%. Some of that is for the property tax relief, as they count that as appropriations. But a lot of this is excess spending that's going on. They should be restraining spending and then putting more towards property tax relief. And so I think there's some things to look at when you come to these overall measures. I'm hopeful that Texas will get this under control, because it's too much spending, not enough of property tax relief, especially if we have a deeper recession, which I think that we will. We want more money in people's pockets, not government spending that crowds out the economy and things of that nature. We're not Keynesians, right? Keynesianism doesn't work. It's been debunked for a long time. We really need to focus on how real economies work, and that's through people, through investment, and things of that nature. And so you want more money in the private sector. So those are some things to think about, but also across the nation, there's more in school choice that's happening. Texas is looking at some big bills with Senate Bill 8. I'm hopeful we can get to universal school choice. Louisiana has some bills that they're looking at some things for this session as well. I know that North Carolina, several other states are trying to add to the states that have already passed school choice, which I believe there are 4 that have passed this year alone, 2 last year. So we've got 6 that have nearly universal school choice. We need more of those happening across the state so that parents can be empowered to meet the unique needs of their kids, not worry about so much about the dollars flowing to government schools, but what's going to be the best school for them. I think that's key for families. And so I'll put some of this stuff in the show notes as well. And then finally, I was recently on the Austin Peterson. He has what's called the Wake Up America show, which I'll put a link to. It's a great show. Check it out. And talking about the central bank digital currency that the Federal Reserve is thinking about doing. I'm for digital currencies, Bitcoin, and things of that nature. I like competitive currencies. I mean, I'm a free banking guy at the end of the day. I would rather there not be a central bank or anything else. And the Federal Reserve has already devalued the dollar so much, just since it was created in 1913 by about 97%. Why would we want it to get into digital currency? So we can screw it up more, find out more information about us and our transactions. And so I think between the personal privacy issues, the manipulation of the economy, and the cashless society that could create would create some major problems. We've already got problems within the dollar, which could be soon losing its reserve currency of the globe with what's happening in China and Brazil, OPEC, and potentially not using dollars, which has been the key way that it's traded. Dollars are traded. Oil is traded in dollars across the globe. They're trying to move to other currencies, like maybe the yuan out of China or others, that could influence the reserve currency, which would influence other parts of our economy. If they went away from the dollar, that means they would be buying less of our treasury debt, which means we'd either have to purchase more domestically or interest rates would skyrocket, right? We wouldn't have the same demand. So we'd have a lot higher interest rates, given that we have $31 trillion in national debt. It's expected to go up, to have deficits of $2 trillion a year on average over the next decade. Just net interest on the debt's going to be over $1 trillion soon. And so we've got some major fiscal issues because of excess spending. And the Federal Reserve has been printing a lot of money, which is why we have such high inflation. Talked about the inflation numbers earlier and the bubble in the housing market, which is busting now. And so you have all this stuff out there. What I hope that we can get to is free market capitalism. That's the best path to let people prosper. That's really what we need more of, whether it be in the states or at the federal level, just across the economy, because we want people to prosper overall. And I think that's a great way to do it. So look, inflation is still too high. We need the Fed to keep acting, cutting and more aggressively their balance sheet, probably raising their target interest rate as well. We've got states that are doing some good things. Texas still has some work to do on its budget, and others, a lot of good work on across the nation on school choice. But let's see that in Texas and other places for universal school choice. And number 3, central bank digital currency, bad idea. We need to get rid of that entirely across the globe and make sure that we have the best opportunities to prosper. So until next time, thank you for joining me on This Week's Economy with Dr. Vance Ginn. Thank you. Have a blessed day. Let people prosper.